we're going to take a look at investing basics. Things we're going to do today, we're going to identify some common types of investments so you can understand what those investments are. We'll take a look at the return on your investments. I'm going to talk about the risk involved in investing and the trade-off between that risk and the return that you hope to receive. And we'll conclude with some common mistakes that hopefully you can all avoid while working on your investments. Investing. Let's take a look at some investing basics. We're going to take a look at some common types of investments, talk a little bit about return on investments. We're going to identify the risk of investments and investing. We'll talk about the trade-off between return and risk, and we'll talk about some common investment mistakes that hopefully you can avoid. Some common types of investments. We have money market securities, cash equivalents, certificates of deposit. Basically, we're talking about things that are very easily converted to cash. Low interest, you can take care of these at your bank or credit union. We're going to talk about stock, individual stock, or owning a company. There are bonds, there are corporate bonds, and there are government bonds. And we'll take a look at mutual funds. The money market securities. We've talked about, I already mentioned, the cash equivalents, certificates of deposit, money market funds you can invest in through different banks or brokerage houses. Let's take a look at stock. What is stock? Stock is ownership in a company. You can buy stock through a brokerage account. Some of these stocks are going to pay dividends. Some stocks are going to increase in value, or they may even decrease in value. One of the things you want to take a look at is the size of a company. Do you want large companies that you're investing in or small companies? Generally speaking, small companies are higher risk than large companies. Large companies have been established. Small companies are still in the process of growing. Some small companies, and some large companies for that matter, don't succeed. They don't survive. Are you looking for growth or income? The dividends are the portion of the profits that the company returns to their owners. I said if you buy stock, you have ownership in a company. You're a part owner. So as an owner of the company, you will share in the profits by the way of dividends. If you're looking for growth, you're looking for that company to grow. You're hoping that the company takes their profits and reinvests it in the company. Maybe develop new products, buy up other companies, but you're looking for the company to grow and therefore increase in value. When buying stock, you want to make sure you diversify. Diversification involves investing in unlike companies. If I were to buy stock, and I go out and I buy Walmart, I buy Target, and I buy Sears, have I diversified? I got multiple companies. Probably not. All three of those companies are rather similar. They're in the same industry. If one does well, the others are probably doing well. If they're doing poorly, they're probably all doing poorly based on things that are going on in the economy. Now, what about buying Walmart, Harley-Davidson, and Exxon Oil? Are those three companies going to react the same in the same economy? Probably not. Those three companies, Walmart, Harley-Davidson, and Exxon, would be unlike companies. That would be getting some diversification. Let's look at bonds. We have government bonds and we have corporate bonds. Bonds are actually a loan to the government entity or to the corporation. Bonds are considered to have a $1,000 par value. That means when the bond matures, the company will pay $1,000. Why is that important? Because bonds may be sold at a discount or a premium. The bond is worth $1,000 doesn't necessarily mean that we're buying it for $1,000. Let's take an example here. I have a 10-year bond that is paying 8% interest. That bond was bought for $1,000. 10-year bond at an 8% coupon means that every year the bond is paying 8% of the $1,000 or $80. And actually that's going to be $40 because bonds are generally paid, interest is paid every 6 months. So you're going to be paying $40 every 6 months or $80 a year for 10 years. At the end of the 10 years, the loan is up and the company is going to give me my $1,000 back. So a bond is an interest-free loan an interest-only loan to the company. The company will pay the interest every 6 months. Now, take that 10-year bond that was at 8%, paying $80 a year, and interest rates drop to 6%. So if I go out and look for a new bond, most bonds are now paying 6% because that's the going interest rate. I'm going to be pretty happy with my 8% bond. Would I sell that bond for $1,000? Probably not, because I like that $80 return. The new bonds are only paying $60 or 6%. So in order to convince me to sell that bond, you would have to offer me a premium. In this case, if you offered me $1,148, I would probably consider selling that bond because that would make up for the loss that I'm going to have if I buy a different bond. It would also make your return, even though you're getting $80 in interest every year, it would make your return closer to the current 6%. By the same token, if interest rates went up and you could go buy a new bond with a 10% coupon rate, paying $100 a year, are you willing to buy my $80 8% bond? Probably not. I would have to discount that as an incentive to you to buy my bond. So interest rates are now at 10%. I could discount my bond to $875, and some of you would consider buying it. Some things we need to keep in mind with the bond. The maturity tells me how long the bond will be outstanding. The yield is your return on your investment. The coupon rate that I've mentioned is the interest rate that the company pays. Remember the par value of $1,000. So an 8% coupon is 8% of the $1,000 that the company borrowed, or $80. The par is the $1,000 value. Remember, the company pays interest every 6 months, and it is returned to the company for $1,000 at maturity. So my 10-year bond that has an 8% coupon is going to pay me $80 a year or $40 every 6 months for the next 10 years, and then I will return that bond to the company and get my $1,000 back. Mutual funds. Mutual funds are a professional managed portfolio that provides low-cost diversification. Professionally managed means there's someone managing the portfolio, buying and selling stocks for us, or bonds, or any other asset that the manager decides to put into that portfolio. A mutual fund is a group of investors who pool their money, give that money to the professional manager, who then buys and sells stocks. It's a way for those of you who don't want to go out and pick a company or don't want to go out and find a specific bond. You can put your money into a mutual fund and let someone else do that selection for you. The load versus no load. No load means no commission. Load means a commission. If you're looking at a no-load mutual fund, there are no commissions involved. You find your mutual fund, you send the money to the company, and they invest it for you. As opposed to a load fund will be sold through a broker or bought through a broker. You'll pay that person a sales charge, which could be as high as 8 or 8.5%. And they help you find the mutual fund or make a recommendation to you on which mutual funds to buy. So in addition to that sales charge, which may or may not be there depending on the type of fund you buy, there's a management fee. Remember that professional manager that I mentioned? He doesn't do it for free. So there's going to be a management fee that is taken from the assets of the fund to pay that manager. There are also 12B1 fees. 12B1 fees are marketing fees and redemption fees. It's a fee that the fund company is allowed to take out of the fund to cover some of their expenses. So we've got 3 different potential fees here that I've talked about. When looking at mutual funds, one of the things you need to consider are the total expenses. How much is being taken out of the fund each year to cover expenses? A mutual fund is low-cost diversification. By buying a mutual fund, you immediately have hundreds of different companies and or bonds in your portfolio. I mentioned diversification. Another term we talk about is asset allocation. Asset allocation is utilizing different classes of security to invest in. For example, we've talked about stocks and bonds. Those are different assets. A mutual fund is not another asset because a mutual fund will have stocks and bonds in it. Some other asset classes could be real estate, precious metals. Maybe you know someone who buys art and says it's an investment. Now, art could be an investment, a little more risky than buying stock or putting your money into a mutual fund, but it is another type of investment. Let's talk a little bit about return on investment. If you're investing, you're hoping to get either dividends or interest, depending on the type of investment. The dividends or interest are paid out of the profits of the company. So if the company's making money, they pay the dividends back to the owners. The other way we make money through our investments are through an increase in share value. The shares of my stock hopefully go up. And then when I sell them, they've increased in value. I've made money off of that increase in value. Stocks are sold between investors. Supply and demand could cause the value to increase, resulting in a capital gain. Better performance of the company could result in an increase, resulting in a capital gain. Let me give you an example here. You decide to buy 100 shares of RDW Incorporated at $50 per share. You hold those shares of stock for a year. RDW pays $1 per share in dividends over the course of that year, and the value of the stock went up. So at the end of the year, you sell the stock for $58. $1 per share out of 100 shares, you have $100 in dividend income. You also have $8 per share that you made when you sold the stock. $58 minus $50 gives you the $8 times 100 shares is an $800 capital gain for a total gain of $900. You made money through the dividends, and you made money through the increase in value in the stock. When we're looking at return on investment, we look at how much are we earning on our investment. In this formula, the return, the amount we earn, or the percentage that we earn, equals P sub T, which is the current price, minus P sub T minus 1, the price a year ago, plus the dividend, divided by the price a year ago. So in this example, we bought our stock at $50, sold it for $58 plus the $1 in dividends, divided by the $50 that we paid for it, gives us 0.18 or 18%. So if you have a stock, you paid $50 for it, take a look at your $1 dividend plus the price increase, and you then can calculate the return on your investment. Now, every investment involves risk. We can take risk and try to measure it. If you've seen a stranger standing out on a street corner, and that stranger said, if you give me $100, meet me here tomorrow, and I'll give you $250. Are you going to take him up on it, or does that sound a little risky? Sounds kind of risky to me. Could it be true? Could this person really show up tomorrow with $250? As unlikely as it is, it's possible. On the other extreme of our risk, we could bring our money to the bank. I could take that $100 to the bank, and they tell me, if you come back tomorrow, I'll give you your $100 back. Does that sound reasonable? I think so. No risk, because we trust the bank. A lot of risk because we don't trust the stranger. The bank, there's no risk. There's also no return. They're giving me my $100 back. The stranger, there was a lot of risk involved, so the potential return is $250. I could make $150. I could also lose my $100. So there's some risk involved there. And then somewhere in between those two scenarios, there's other elements of risk. I could put my money into a certificate of deposit, and the bank promises me that a year from now it'll be there plus interest. I could give my money to some investment company who tells me that they expect to get a return on my money. There's some risk involved there. In addition to the risk, we run the risk of inflation. When you invest, are you keeping up with inflation? Inflation is the increased cost of goods. So if I put my money in the bank at maybe 0.5% interest, and I'm going to leave it there, save it, because I want to buy a car next year. I've got the money today, but I'm going to wait until next year to buy the car. If that car increases in cost by 4%, an average inflation rate, So next year's car is 4% more, and my bank is only paying me 0.5%. Will I have enough money to buy that car next year? No. My return did not keep up with inflation. So I'm actually losing purchasing power unless I find an investment that will give me a return greater than the cost of inflation. Interest rate risk. There's interest rate risk, particularly in bonds. Remember that 8% bond that I bought? And now interest rates went up to 10%? I have 8%. I can't get any more. But there's also the possibility that the interest rate could drop to 6%. So there is a return to that risk. I might do better. Investing in the stock market, there's always the risk that businesses might fail. If a business fails, I could lose all the money that I invested in that company. That's a risk I take when I invest in the market. Could that company also be extremely successful? Absolutely. So I'm taking a risk. I could lose my money through business failure, but the reward, potential reward, is there if that company is very successful. And then there's market risk. Just by being in the market, there's risk. If you listen to the news each night, some nights the market goes up, some nights the market goes down. There's a risk involved in being in the market. Now, when we take greater risk, we expect a greater return. That's how we tie our risk to the return. Some of you are going to say, I don't want to take risk, and that's fair. Not everyone takes the same amount of risk. Some of you are low-risk people, and you're going to take low-risk investments into consideration. Others like the idea of risk and the potential for that greater return, so you're going to take greater risk. Remember, greater risk, we expect a greater return, but we could also experience a greater loss. That's the element of risk. Let's talk about some common mistakes that investors make. Unrealistic goals. In your financial plan, you're going to establish financial goals. Are those goals realistic? If the goal is unrealistic, you may be inclined to take unrealistic risk. You may be looking for an investment that yields more than you should be looking for based on your risk tolerance. We also sometimes lose sight of our goal. What is your goal? Particularly for this investment that we're looking at. If you're looking at an investment, what is your goal with that investment? When you lose sight of the goal, we tend to lose sight of where we're headed with that investment. Two things can happen. We can get greedy or we can get scared. If I've achieved my goal, do I leave my money in that stock or mutual fund? Or do I find something different? If my goal was to get $50,000 for my college fund, I found a mutual fund that met my risk tolerance. Maybe I took a little more risk than I did in some of my other funds. My fund goes up to $50,000. Am I now greedy and, I like this $50,000. Let's leave it there. Let's keep going and get more? Or do I say, I met my goal, that $50,000 is the college fund, let's put that aside. And now let's invest somewhere else. Maybe I can put money towards my retirement plan, whatever. Generate a new financial goal and start working towards that. By the same token, we can get scared. Some stocks decrease in value. What if that college fund, I'm adding money to it every month, but the value is going down because I selected a risky fund And sometimes the risk doesn't work out and I'm losing money. Do I get scared and stop investing? Do I sell out that fund and go find something different? If you set a goal and you did a fair assessment, you found an appropriate investment, then stick with that investment up to your goal limits. That might be a top-end goal, it might be a bottom-end goal. Maybe I can deal with this investment unless I lose 10%. At 10%, I need to get out. If you've set that goal, you'll know when to get out of a particular investment. Some people like to borrow to invest. If you borrow to invest, your return has a built-in cost. If you're paying 3% to borrow money and you're earning 5%, there's only a net gain of 2% there. Based on the risk that you're taking to earn 5%, you're only earning 2%. And remember, there's no guarantee on the potential return. You could borrow money, think you're getting 5%, and all of a sudden that the 5% becomes 2 or 3, and now you're losing money based on your investment. Some people like to take additional risk to cover previous losses. If your risk tolerance didn't change, something didn't happen to change your risk tolerance, then don't take the added risk. You've taken a look at what your risk tolerance is. You've found something you're comfortable with. Sometimes you're going to lose when you're investing. That doesn't mean you go find something even riskier to make up those losses. Remember the losing side of your goal? It's probably more likely there you're going to get scared and stop investing. Again, don't lose sight of your goal. Don't take additional risk to cover other losses. And here's my favorite, accepting advice from the expert. There's always an expert who knows more about the stock market than anyone else you know. Ask yourself, what makes them the expert? Did they just happen to buy one stock and get lucky? Or do they really know something? Are they really an analyst and they've found some things that you weren't able to figure out? If they're truly an expert, they'll be able to explain what it is that they're doing and not just tell you, go buy XYZ stock, it's a winner. I bought XYZ and I made a ton of money. Well, if they made a ton of money, are they still making a ton of money? Or has that stock now leveled off or maybe even dropping? Before you accept advice, verify that they really are an expert. If you want advice, talk to a financial advisor. Financial advisors will sit down and explain things to you. They're trained and they study the markets. The neighborhood expert or the classroom expert may not be all that much of an expert after all. Good luck investing. Okay, we've talked about the common types of investments. We've talked about money market securities, we've talked about stocks, we've talked about bonds, and we've talked about mutual funds. Those are the most common types of investments that you may be investing in. Understand the risk involved with each one of those investments. As you look at your goals, take your dollars and apply them to specific investments and help you achieve each one of your individual goals. Now, we've been through several segments of personal finance. The last thing you as students need to do is complete your final exam and submit your personal financial plan. Be sure to look on Blackboard. Take a look at the requirements in that personal financial plan. The best financial plans are the ones that you apply your real expenses to. I've given you a proposed budget. If that works for you, great. If you have more accurate numbers, by all means, use the accurate numbers. When you're setting your goals, make those goals your goals. Find the dollars in your budget to achieve the goals. If they're your goals, they're going to be that much easier to achieve. I hope you've enjoyed learning about personal finance.